As a final discussion in this chapter, let's take a moment to consider a few elements related to income taxes. First of all, let me say that taxes are extremely important in decision making that corporations are engaged in. It's been my experience that when you observe a company engaged in a structure that looks very strange and confusing, it's frequently motivated by some desire to reduce corporate tax burdens. In the United States, corporate tax rates are progressive. They are lower for low incomes, for corporations with low income, but they rise fairly quickly. The top corporate tax rate is 40%. It's actually in the 30s, but if you include state taxes and potential foreign taxes, it's more likely to be in the 40% range. This is, compared to the rest of the world, rather high. Most of the rest of the developed world have cut taxes over the last 2 decades, and the U.S. corporate tax rate is now one of the higher rates. The importance of these taxes and tax deductibility can be seen in this next little example. Let's consider 2 companies that have earnings before interest and taxes that are identical. They both have earnings of $400,000, but one company has borrowed money and therefore has to pay interest, and they're paying $100,000 in interest expense for the year. This reduces their earnings before taxes and their taxable income, and so they now have a taxable income of only $300,000. Assuming a corporate tax rate of 40%, Corporation A, on its $300,000 of income, is going to pay taxes of $120,000. And Corporation B is going to pay tax on $400,000 at 40%, so it's paying $160,000 in taxes. We deduct those taxes from the 2 firms' earnings, and we see that now their after-tax earnings are different. And the firm that had interest payments, in fact, has lower after-tax earnings than the firm that didn't, but the difference is only $60,000. So while the firm made a payment of $100,000, the reduction in earnings is only $60,000, and the reason is because, in essence, the government, by allowing a deduction, has subsidized the payment of interest. Dividends aren't deductible. Interest is deductible. So companies have an incentive to finance more of their business with debt and less of it with equity. The higher the tax rate is, the more likely they are to pursue that strategy. Let's look at another element where taxes become important. We've already discussed the fact that depreciation is not in and of itself a cash flow. Having said that, depreciation impacts a cash flow. Specifically, it impacts the tax liability, or the tax cash flow. The government allows depreciation as an expense, and therefore allows depreciation to reduce a corporation's taxes. Now, depreciation isn't a new source of funds, but we refer to this as providing a tax shield. Depreciation provides a tax shield that is equal to the amount of the depreciation times the tax rate. So let's go back and look at 2 companies. We'll follow a similar format to what we did before. We're looking at 2 companies, both of which earn $400,000, in this case before depreciation and taxes. One of the corporations has depreciation of $100,000. The other records no depreciation. The firm that had depreciation reduces its taxable income to $300,000. Its Corporation B has taxable income of $400,000, and we notice that the tax paid by Corporation A is in fact now lower than the tax paid by Corporation B. These firms were identical in every other respect except for the amount of depreciation. The firm's earnings after taxes are shown on this line right here. And now, in order to estimate or to calculate the cash flows of the firm, because depreciation itself is not a tax expense, or is not a cash flow, we're going to add back the depreciation at this point. This is the same depreciation that we deducted up above, and this leaves us with a cash flow of $280,000. The cash flow for Corporation B is $240,000. The difference is $40,000. So while depreciation is not a cash flow, the tax benefit from depreciation actually generated cash for us. It generated $40,000 in additional cash by reducing our tax liability by $40,000 right here. That's the source of the additional cash flow that we see down here on the bottom line. So again, depreciation isn't a cash flow, but it does impact taxes, and therefore it has to be considered when we do analysis when we're concerned about cash flows.